Welcome back to the Bitcoin Layer. I'm Nick Bhatia, and today we have a very special guest, Andy Constan, to talk about rates, the Fed, and U.S. Treasuries. Andy, thank you so much for joining us.
Oh, it's a pleasure, Nick.
So I want to start with your background. Can you tell us a little bit about yourself and maybe your professional background?
Sure. So I started at Solomon Brothers in 1986 and was a corporate finance analyst in their quantitative group doing securities valuation. Then I had the honor of representing Solomon on the Brady Commission, which was the presidential commission to investigate what happened when the stock market crashed in 1987. That brought me to the trading desk after it was over to continue my career as a convertible bond trader. I did that for about 7 years, and then took over the equity derivatives trading business, and then ultimately left Solomon Brothers in 2003. It had merged with Smith Barney and Citigroup and was quite a different place than I had started with. But left there running, at the time, was running global equity derivatives sales and trading, and a member of the equity operating committee, management committee. I started my own hedge fund, which was a relative value fund. I was doing all the equity relative value trading, and some of my partners that joined me from Solomon did fixed income. That lasted about 4 years before our partnership broke apart. And then during the financial crisis, I was starting to start my own fund, a smaller fund with just a few of the partners, but we never got off the ground. And so after the financial crisis, which I largely saw from the sidelines, I started at Bridgewater Associates and learned macro at what I think is the greatest shop for understanding what's going on in the world and how that affects global securities. Did that for a little over 3 years, and then moved to Brevin Howard, where I tried to help Alan Howard build a systematic macro. They are very highly discretionary at Brevin. And that went well, but he really wanted to actually use me as a strategist for his portfolio managers, so I became the chief strategist. And then when he decided to offload his research team as separate entities, he funded my business, which is called Damp Spring Advisors. And what I do there is advise hedge funds on finding alpha. And I've also about 15 or 16 months ago, started tweeting some of my thoughts on Twitter, and somehow had a voice that people responded to, and have built up about a 60,000 person following on Twitter.
Great, thank you for sharing. And that's how I found you, is on Twitter, and you were followed by some of the people that I follow. I think that's a lot of the times how we stumble across people on Twitter, is we trust the people that we already follow to bring new opinions that can bring a fresh angle. So I've really enjoyed your analysis on rates. So let's talk a little bit about the work that you do right now advising. Are you advising on exclusively macro topics, or is it more wide-ranging than that?
So for the hedge fund clients, I can do a variety of things. I can go deep in a variety of areas, including RV, credit, relative value, but where I'm really spending almost all my time is in macro. And so trying to find alpha in the macro world.
Okay, great. So let's get right into it. Right now we have CPI tomorrow, the Fed on November 2nd. The money markets show pretty much 100% chance of this 75 basis point hike happening. I don't know if one CPI print is enough to move that, especially given their communication. So we know what's going to happen on November 2nd, more or less. It's what is going to happen after that, I think, that is up for debate. And it's a very heated and energetic debate right now, in terms of people on one side think that we are in for 70s style inflation and 5% Fed funds, much lower risk assets. And then people on the other side think slowing inflation, cracks in the financial plumbing, something is going to cause the Fed to pause, let rates digest, and risk markets might withstand some of the pressure that they're under. So how do you see the situation, and just give us your overall outlook right now?
Yeah, so I guess at the high level, about a year ago, 10 months ago, Jay Powell mentioned the balance sheet in his press conference on December 15th, and that set the tone for the year. I observed that at the time that it was kryptonite for assets, and later wrote about it on December 29th that the high was in for 2022 in January. And that's fairly well played out in terms of the outlook. And I consider the quantitative tightening to be the bigger and more interesting thing for financial assets, while the rate hikes, I think, are the more interesting thing for the economy and whether we successfully fight inflation or not. So I'll take each of those things. And I guess the first thing is that since quantitative tightening has begun to be front run back in when the minutes came out and people all of a sudden realized that this was going to be an issue, asset prices are down sharply pretty much across the board, from the most speculative assets to the least speculative assets, like the 2-year note. Every asset is down. Risk premiums are much higher. And so I look at that and I see what's coming, which is more QT. That isn't changing. We can get into the mechanics of it, but I consider the important thing to not be the runoff, which is just the Fed getting paid, but how that is financed. And it's financed by Treasury issuance. And so that was going to be large anyway and compete with the private sector for dollars. And it's getting bigger because of deficit spending. So there's quite a bit of supply that the market has to absorb over the course of the private sector has to absorb over the course of the next however long quantitative tightening lasts. And so, that headwind is blowing very hard. In my view, it sort of caps asset prices. And at the same time, asset prices have responded. And so, at 4,800 and 2.1 on the 30-year note, with just front running being the headwind on assets, they were quite vulnerable, and so they were hit quite hard. This summer before Jackson Hole, we had 3.25, 3.5, 30-year notes, and 4,200 S&P, and that was a great time to be, once again, expect the headwind to sharply hit assets. And then obviously Powell catalyzed it with his hawkishness at Jackson Hole. And so here we are at 3,600 and 4%, and I think we're in the market's much more resilient to that headwind. And so I think you can make a bull case, you can make a bear case. I think there are very few bull cases being made. So I'm actually making a modest bull case right now that we, once again, run into what I consider a descending cap on markets, on asset prices, because of oversold conditions, positioning. And I think and this comes to your point, which is this idea of hawkishness of the Fed, I think we reached a point of, at least for this stage, and my outlook is sort of the next 6 months, of maximum hawkishness from the Fed. I agree, 75 is it in the bag? Pretty much. And I believe 4.5 is pretty much in the bag as a terminal rate. Will it be 4.25 or will it be 4.5? We have 4 meetings till through January. Sorry, 4 meetings through March. Could they go 75, 50, 25, 25, or will they go 75, 75? And then, I'm not sure what the terminal rate is, but it sounds like around 4.5. And I guess my point of view on that is that the Fed has been very clear, certain governors more so than others, that they wanted to front load this and get the job done. At the same time, they are an incremental organization, and this is a lot to have done. So the Fed has done a lot, and it's planning on doing a lot. And I think at that point, it's a sensible time to, observe what's happened. So my central case, and I believe it's, fairly likely to happen, is we, hit a terminal rate with not a lot of fuss around an increase in the terminal rate or a decrease in the terminal rate over the course of the next 3 to 6 months. And then we see. So I've been thinking a lot about where I stand on inflation. I've been fairly consistent that I think the problem is really needs to be dealt with, regardless of whether when it turns, it needs to turn. And so I've been on the what I termed higher for longer, in that I think it's not just higher for longer, but we really have to make sure this kills inflation. And I think the Fed is committed to that. Now, there's lots of people that say, well, they're going to break things and, they're going to pivot. And, you saw what happened in the UK and who knows how that all plays out. But I think inflation is going to be persistent. I have reasons for that. The principal reason is while I think the monetary and fiscal impulse that caused this burst of inflation is going to run out eventually, and consumers can keep up with inflation, keep their demand if they have increasing wages, access to debt, and a willingness to take on debt. And they have all three of those things at the moment. They are going to run out at some level in terms of taking on debt or willingness to take on debt as interest rates rise. So I think that, and obviously quantitative tightening is taking some of the available credit out of the market. So I think that levering up part of inflation is, reaching its end. But then you have the wages, and it's an interesting time. We really have to, it's obvious to me why the Fed is so focused on wages, because right now, you can have extended inflation if the labor capital leverage shifts toward labor. It is shifting toward labor. It may shift it may shift farther and be more persistent. And if that were to happen, labor spends, and that becomes of somebody else's wages, and that is, why you get a wage price spiral. I see that as a risk. The other risk I see is increased government spending, particularly around globally, around duplicative supply chains, domestic energy production, and deglobalization more broadly, 3Ds, that could generate government spending. And so I think we have quite a challenge in terms of long-term inflation.
And so I want to ask you about QT, but really quickly on inflation, do you think that the Fed is going to change their target at some point? Because we've been hammering on about 2%. So from 8 to 2, it's going to take a long time to get there. But, I agree with you. This sticky component to the inflation, while some of the headline will come off, it's going to be around. So are they going to adjust their target in an outright way in any time in the next 6 months?
Right. So I hope not, and certainly not in the next 6 months. And the reason why I say that is they've done a lot and they have to wait and see. That could be something that becomes it concerns the market every day, but people speculate about that all the time. But I think you actually have to wait for at least a year before that conversation even begins, because they've done so much and it operates with a lag. I hope they don't, and I hope they don't for a very simple reason. I think the market is perfectly fine with 2% inflation and 2.5% inflation and probably 3% inflation. What you need is stable prices. Stable prices allow businesses to plan, and the 2% number really was just high enough so that you could cut real rates to without hitting zero, and cut nominal rates to zero when you had deflationary environments. And so, conceptually, I have no problem with 3%. I just have a significant issue regarding what I've seen as other forms of this confidence game, which is once you devalue your emerging market currency, immediately the conversation goes to when you're going to devalue again. It doesn't accept that you've devalued and that's the one time you're going to do it. And so I would be very concerned about a 3% number then simply being tested to when are you going to go to 4? And that would be very destabilizing and credibility would be lost. So I hope they don't do that. And I hope they succeed in cutting inflation. And I think they could. Now the real question becomes is not to me whether they bring the target down, it's rather they bring the terminal up. For all summer, all we heard about starting, after the first 75 basis point hike and the July 4th weekend of recession talk, all we've been hearing about is pivot. And that means a premature, or maybe not, to me it means a premature cut. That conversation, while still modestly priced into markets, has ended by and large. Now the conversation has flipped completely over to, oh my gosh, and if we get a hot number tomorrow, which is, I think, likely, the conversation is going to be, is 4.5 terminal or is it 5.5? And I think that hysteria is just as pervasive and wrong as or becoming as pervasive and wrong as the premature pivot was this summer. But it's going to impact. But if it goes in that direction, it's going to impact markets. I think my central case ends up being the central case. 4.5 by March. Wait and see.
Okay, great. And so let's go back to QT then. What is your outlook on QT? How long do they wind down the balance sheet? Something I've been writing about this year is that a pivot in QT takes a long time to signal to the private hands, basically, to signal them that they have to absorb a rundown in the Fed's portfolio. So what is your outlook on QT? How long will it last? When do you think there's a pause in the balance sheet wind down? And can you even detail some difference between their Treasury portfolio and their mortgages?
Sure. So I think the current program of 60 rundown of Treasuries and 35 rundown of mortgages is what we're going to see for maybe fully through 2023. I do think that they reduce the size of the quantitative tightening before they cut rates. So wherever we're at, say we're at 4.5, and we're stick at 4.5, we're not going to 4.25 and doing as much QT. Because so anyway, that's my view on that. And, they acknowledge that quantitative tightening and quantitative easing for that matter, are weak levers to use when you're trying to impact growth and inflation. And they were weak, from 2008 through 2020, they were weak on causing inflation. We didn't have a significant inflation during the first few phases of quantitative easing, but they're very effective at inflating assets. And that's actually the mechanism that these things work. They inflate assets, and that has a wealth effect on a small portion of the society who then spends. But it has this big impact on assets, and I could imagine there'd be a reason to once you saw inflation reaching a crescendo, starting to head down in a reliable way, to reduce the runoff, you know, as a signal that you're eventually going to cut rates, but not before you cut rates. And so that's sort of my outlook on that. And in terms of mortgages, um, I'm a little confused, I must say. I try to model every month's runoff, and mortgages, they're late to settle and they've been creating some balance sheet noise. But I think we're at a steady state now, and you're going to start seeing fairly close to target runoff. But my perception of when quantitative tightening was announced was that there were a number of people on the committee, and their basic operating plan was to have a balance sheet that it consists exclusively of treasuries. And they're a long way from that. And so I've been expecting each minutes to see some discussion on, heading in that direction. And in fact, today's minutes, which came out a few hours ago, 2 hours ago, hinted that, well, a couple of the members were saying, what are we doing on this? And oddly enough, in the press conference from September, Powell was very clear that that was not a part of the plan, that selling mortgages outright was not part of the plan. So I'm a bit confused of where the committee is on there. I see I see what's happening in the housing market. I see what's happening in mortgages, and I get why they may not want to put some of these low coupon mortgages, high duration, low coupon mortgages into the mortgage market. But it is inconsistent with their basic plan. So I'm looking for clarity on that from Powell at the next meeting. Why is he so hesitant to add mortgages to the mix?
Thank you to my sponsor, Voltage. Voltage is a great Bitcoin and Lightning Network company that is focused on providing infrastructure for businesses and people that want to spin up Bitcoin and Lightning nodes. Make sure to get Voltage's help setting up your node today. And so that's a good segue to my next question, which is about some of the more nuanced components to financial markets that the Fed looks at for financial stability. So we know we've talked about inflation, we've talked about wage inflation, we've talked about the economy, but there are corporate spreads, there's the corporate new issue market, there are funding markets, bank funding, Eurodollar funding. There are a lot of ways that a financial system can require a central bank to come to its rescue. So, sure. What are some of the components you mentioned? We're seeing wides in agency spreads right now, really off of QT. I think is the main driver there. What else are you watching to see, and do you place any probability in an event happening in some of the corners of fixed income that could warrant a Fed pause short of 4.5, let's say?
Yeah, so I break that down into different sectors, I guess, and there's the day-to-day plumbing and financing of longs and shorts for levered players, banks and financial and shadow banks and hedge funds, etc. There's the intermediation of credit that these entities do, and there's the potential for speculative investments that rise when you have this sort of volatility. I think the best example, obviously, that is going on in the UK right now with the LDIs and their levered exposure to long-term interest rates. I've lived through a lot of these things. In 94, 87 we saw what we saw, but in 94 we had mortgages and not their credit risk, their convexity blow up everybody from Merrill Lynch to, a variety of hedge funds to the Orange County Treasury. And I guess what I would say about that is, and then the 98 had long-term capital, obviously, as a similar circumstance. I don't see rates volatility, levered rates volatility, as the thing that breaks the U.S. market, but you never know. So it's obviously something you can't just discard, but that's not my first guess. The second one is credit, and credit spreads are wider, but they're nowhere near as wide as they have been. And, this is an important idea broadly, which is this has been a rolling bear market. This has not been a sudden crash. And so, sorry about that. And so my high level is that the financial system has had plenty of opportunity to delever, and I believe has. And there's lots of evidence that the leverage in the, across every sector has come down a lot. And banks are in great shape, and so that doesn't seem to be a transmission mechanism for a contagion. So I don't see, so I'm probably blind to it, and there's probably something, but I'm not really that concerned about the U.S. market breaking in that way. I am concerned that the Fed goes too far or doesn't go far enough. But I'm not concerned that you have this sort of financial calamity that we've had in past more sharp sell-offs. So both Europe and the UK is ahead of the Eurozone, are faced with some fairly serious spending requirements to re-stimulate their economies. They're going to go through a heavy recession, both parties, and they're going to need financing, and they're going to need to spend. Europe, in particular, to reestablish broken or permanently our enemy supply chains, and that's going to be expensive and is going to push put pressure on the capital account of the balance of payments when they try to finance this both domestically and with foreign. And at the same time, that spending will be create domestic demand, and that will generate, and this we saw in spades in the UK, that'll generate pressure for the current account to grow as well as domestic spending exceeds domestic wealth. Domestic income. And so those two pressures are what generally occur when you have a balance of payment crisis. And so I think the UK is either on the precipice, or they pulled back off the precipice when they canceled one of the budgetary issues, but they're still going to try to do QT after whenever if they stop on Friday, and they're not doing enough to cut demand. So I am very worried about the currency. And that'll make it very difficult for them to do what the U.S. is doing. The U.S. has the benefit of a very strong currency to import deflation, while the other ones are finding that quite difficult. So I'm fairly bearish on both of those currencies. As it relates to the economy, you can that spending can actually lift the economies. So we'll see how that develops and whether they will begin to spend, but that'll have to happen when things in Ukraine at least calm.
Right. And so how do you see the demand from Europe, from UK, from Asia for US Treasuries? So let's bring it back to the debate that we're hearing about U.S. Treasuries. Just to set up for the listeners, both sides of the debate. On one side, it is we have a structural decrease in demand from abroad for U.S. Treasuries, also a structural decrease in demand from some U.S. banking regulatory requirements. These are both putting, and then you throw in QT, and all of that extra supply has to come into the private hands. So we are in for, much higher for longer U.S. rates as well, if I could borrow that. The other side is that the global economy is in a contraction right now, or entering one, depending on if you're looking at Europe or a U.S. Going into recession sometime starting now or going on a go-forward basis.
Sure.
That will drive an expectation of growth and inflation forward lower. That should provide a case for real rates where they are and bring demand back into the Treasury market, and we'll see a rebalancing and a move lower in U.S. rates. So how do you see the outlook on U.S. Treasuries, but less just from a prediction on yield, but more for the secular demand for Treasuries and maybe some of the bigger conversations on Treasuries? Can the U.S. government go on in a QT environment forever, or are they actually reliant on QE to finance some of that debt?
Yeah. So I guess the first thing I'd like to say is that every dollar that is deficit spent becomes a private sector savings. So, and that private sector savings needs to get invested. So, and this isn't an MMT sort of idea. This is simply the fact that when a government issues a 10-year bond in excess of what they want to spend, and in excess of their net of taxes versus other spending to spend, that money gets handed to somebody in the real economy on the private sector, and that then flows through. The problem is that there's a delay between when that money is being spent and cycling through the economy and when it actually lands on a saver's desk and they have to then choose to invest. And how they choose to invest may actually be different things than what the government is actually selling. So there's a lot of big mismatches, and I think this is broadly misunderstood about that, in that there is increasing demand for bonds because there's increasing supply, and that money literally gets printed. It's not the Fed printing the money, it's the government saying, you now have, we're going to take your money, but we're going to hand it to somebody else, and we're going to give it back to you eventually. That's the way things work. And so anyway, now it's a question of a burst of that. We're having a burst of money that was provided by the Fed and now needs to be provided by the private sector. And that means that you're going to have to attract demand. And, that's really the headwind that I've been talking about regarding QT. And that headwind not only affects the Treasury market, but affects all assets, because if you press a Treasury bond down low enough, the expected return on risk goes up, and it looks more favorable than a corporate bond. And then that corporate bond needs to get sold, but somebody has to buy that. And the buyer is going to demand a high expected return because he could otherwise have bought this Treasury. So that plays through the whole system as this excess of supply and demand spreads. So that's what's happening. We're seeing all assets fall because there's this excess of supply. And now the question is, so how far does it go? And the answer to that is, right now we know who's not buying. We know that, we think there's some speculation around this, But certainly the common wisdom is that China and Japan are selling treasuries to defend their currency. That might not actually be quite exactly how they're doing it, and that's a subtle point, which I won't bore you with, but they certainly are defending their currency. We've seen that in markets. And they have been, for a while now, reducing their treasury holdings. So let's assume they're doing it more. They're not buying. We know that. And then you look at banks, and you see that banks have not been buying either. And you mentioned that it was a regulatory thing. I think there is something to that, and we'll come back to that. But it's also a risk thing. You know, when your boss is Jamie Dimon, and Jamie Dimon says rates are going to 5.5%, you're not buying a 3-year bond, no matter what you can finance it at, because you're going to get fired if if you're riding the curve at J.P. Morgan. So, and you can see it. You can see they've reduced. Now their deposits have fallen a little bit, and that's another technical story. But you can see they're not buying treasuries. So that's two major players. The two major players that buy treasuries are banks and foreign governments and the Fed, and they're not. None of those are. So it's very hard. And the thing is that those players are all levered. They all can either print money to buy a U.S. Treasury, or they can print yuan and sell the yuan to buy a U.S. Treasury, or they can lever their own balance sheet and buy U.S. Treasuries. And so the levered players are the ones that are selling, and what's left is mostly unlevered players, and they just can't buy as many. And so, you know, that dynamic is having a significant impact on risk premiums, regardless of the economic situation of all assets. And so the question is, when does it end? And it ends like anything else, which is when animal spirits say, I'm going to lever up and buy this thing, whether they're a bank or a hedge fund or a product that is sold to retail or whatever. Leverage comes into the system when, and it's usually secured, and so it's safe leverage, not for the investor, but for the provider of leverage. And so I expect at some level we start to see speculative demand for treasuries. We're clearly not there yet.
Let me ask you then about this narrative, because what you're characterizing is a scenario in which eventually treasuries find their floor price, people buy the yield, and they'll actually lever up because it's attractive, given the entire risk spectrum and where risk-adjusted returns are. So how do you respond to the narrative that U.S. treasuries are in a bursting bubble that can only be held together by QE and purchases from the central bank of treasuries? I know it's a dramatic characterization, and it's a narrative that I disagree with in some ways, and I guess agree with in others. But how would you respond to that sort of characterization of the treasury market and the dynamic of quantitative easing?
Right. So I like that we have a central bank that leans against the prevailing winds of the economy, and I don't love that they just were forced to use a lever during zero interest rates of purchasing assets, but it's an okay lever. It's good to lean against the economy. It's better to have a Fed than not have a Fed, but you don't need a Fed. The only question is, is price. The Fed, if it were to, is right now influencing the price lower. So they're leaning against price. No one's particularly complaining that they're leaning against price. They're leaning against price. If they stop leaning against price, that's a good thing. That would help. Do they have to actually then support price? It's not clear to me that they do. There's nothing but a dampering effect, hence the name of my company, Damp Spring, that these central banks provide, that if they were to be removed from the equation, the markets would clear. They'd just be messy and volatile, and it wouldn't be as easy to plan anything, government expenditures or private sector expenditures, if you didn't know where, interest rates were. But there's a market clearing price. Anybody who thinks differently is, I think, nuts that there's not a market clearing price for every point on the curve of every country that's able to print its own currency.
And how do you see then? Talk just quickly about debt to GDP of the United States. We know that it's well above 100%. We know that historically that's a danger zone. So how do you see the U.S. fiscal situation? Is it something that concerns you, as it seems to certain people in D.C. when it's popular to do so, or is it something that you see as a longer term issue that the U.S. will muddle its way through? How do you see that?
Yeah, I'm more of the so unless there's a over levered player that is forced to liquidate, I see, and I'm not sure that exists here. I don't think that this level of GDP, debt to GDP, or a meaningfully higher level, would put us in a position where we couldn't roll our debt. I could be wrong about that, but that's my basic assumption. However, it's a it's a it's a standard of living issue. If you look at the way we spend today, we're spending today. That means we have to consume less in the future at some point. And MMT is popular because it lets you continue to be able to spend. You don't never have to pay it back, essentially. But unfortunately, that has a direct impact on inflation. And so, where are we now? Right now, we're in a position where we can inflate the debt away and have nominal GDP above our nominal cost of interest, which is where it is right now, and we're actually decreasing our debt to GDP for the next 1 to 2 years, even though it seems like this is a terrible environment. We're actually, if we didn't write another deficit, we could pay our interest, we could pay and we could meet our obligations with our tax receipts, which are rising dramatically because of nominal GDP going up. The problem is we then continue to spend. And so that is a problem that plays itself out in society. If you choose to operate the system we have, you choose to hand money today to a set of people in the economy, and I'll make no judgment on who those people are. It's always political, and those set of people experience an improved standard of living. And one day in the future, another set of people, who many may not even vote right now, are going to experience a lower than trend standard of living. And that's just what happens. And so that's the politics of it. And you can change the politics. You can change the way that money's allocated now and who ultimately pays for it in the future. But that's the reckoning you have.
It sounds like you're a student of demographics, and it's an input to your investment process.
Well, it's really societal because the choices that are being made are cities versus rural, they wealthy versus less fortunate, poor. And those are things that can break apart societies. And so I don't think it's an easy thing that we're going to deal with. It's going to be very, very hard.
So are there publications or books that you've read over the past year or two? As I want to get current recommendations for
Yeah, I like
our
both of Ray's
listeners.
books. I think The Big Debt Cycle is the better book and less political. But I also like the Changing World Order. Both of those are, it's a little pro-China for me, but both of those are books that I think lay out some of the issues. So those are the things I've read most recently. I like them both.
Great. And Andy, can you give our listeners and viewers where to find you, how they can follow your work? And I really appreciate you joining us today here at the Bitcoin Layer, talking everything Fed, rates, and Treasuries.
Sure. So my website is dampspring.com. That's DAMPED spring.com. And you can find me on Twitter at Damp Spring.
Thank you so much, Andy, for joining us, and we hope to have you back soon.
Pleasure, Nick.